Hello traders, Gary Wagner here. It is 12:30 in Honolulu, 6:30 in New York on Friday. Happy Aloha Friday as we say on the islands. It is the 28th day of June, 2024, and this is the evening report for gold and silver, our weekend review. Today, the Bureau of Economic Analysis released its most current information on inflation vis-a-vis the PCE report, showing that inflation is declining fractionally, coming in 0.1% lower last month than the prior month. Yesterday, we saw gold gain about $28, and I believe that was in anticipation of today's report, which is positive in that it is beginning to show a trend that the Federal Reserve can act on and cut rates in September. And that is why today we saw gold decline fractionally, giving up $1.80, taking the most active August contract to $2,336.90. Ever since the last week of May, when gold traded to its all-time record high, we saw a price decline, but more importantly, we saw gold enter an area in which it's trading in a narrow and defined trading range. To illustrate that point, I've converted our chart into a Japanese average chart called a Henkin Ashi. A Henkin Ashi differs from a standard candlestick chart in that it fixes the open on the midpoint of the prior day, smoothing it out. You can see that when gold enters a bullish phase, it can be characterized by large body size and the absence of lower wicks. And the lower wicks are exceedingly important because what that signals is that at no point did gold prices trade to or below the midpoint of the prior candle. That is when these lower wicks occur. Typically, that signals that the strength is beginning to diminish. And that's what this chart is best suited for, which is determining the strength of a trend and key levels or points in which you get a pivot or key reversal from bullish to bearish or bearish to bullish. You can see that right here where we had very, very strong body size, and then we had a reduction in body size, small-bodied red candles, but this downtrend or selling pressure never really developed into a full-blown correction because you went back to alternating candle color and then returned to a bullish phase. And you can see that as the second part of this rally, part one here, part two here. And then you can see the trend weakening very quickly, moving to red, and then you're getting these alternating candle colors up until it makes one last move to the all-time record high and takes us to the last week of May when gold prices begin to trade in an exceedingly narrow and sideways trading range, which brings me to my current interim analysis and forecast for gold. In October, gold was trading at around $1,900 and rallied up substantially to approximately $2,200 per ounce. Following the $300 gain, gold entered a corrective period with a pattern called a compression triangle, with a 5-wave count labeled A, B, C, D, and E, which completes the correction, and then we look for a thrust. A thrust occurred when gold prices broke above this upper level resistance line and signaled a parabolic move in gold from about $2,050 up to about $2,250. From there, gold traded sideways with a bias to the downside. We identified a flag or pennant formation that signaled yet another parabolic move once it broke above the upper resistance line here, and that took gold to the first of two record highs. The entire move from the lows at $2,000 per ounce up to the all-time record high can be viewed as a full impulse cycle which is composed of 5 waves, 3 primary waves moving in the primary trend direction, this being our wave 1, and that is followed by waves 2 and 4, our corrective waves, and completing the count on a 5th wave. From there, typically, we will enter another correction. In this case, it was an A, B, C, which causes to postulate it will be followed by a repeat of the impulse phase after the conclusion of the correction. However, currently, because gold traded to this low at about 2,300, traded up to about 2,370 and came back down, we have not gotten confirming data to back that model up, meaning we still could see a further price decline, but if this current model holds weight, we will see a trade off of these lows and begin the next bullish impulse phase. Traders, realize this is but one model of many potential models, but in our estimation, a model that has a decent probability of unfolding. This has been Gary Wagner, wishing you as always good trading. We'll talk to you after the weekend for the next daily update and review. Bye-bye.